Right now, before a single futures contract trades on American soil tonight, oil infrastructure is burning in Tehran. Black smoke columns are visible from satellite imagery. Residents drove to work Sunday morning through streets slicked with crude that had drained from ruptured depots and caught fire. Iraq's oil output has collapsed by roughly 60% as tanker corridors close. And on Hyperliquid, the decentralized platform that doesn't wait for Chicago to open, crude is already trading at $115 a barrel after touching $126 earlier today. The paper markets are quiet. The vaults are not. Here is what this video is actually about. We are entering a war economy, and almost nobody is pricing it correctly yet. Not the duration, not the supply implications, not the strategic architecture underneath, the part that connects energy markets to gold, sovereign balance sheets, and the accelerating drain of physical metal out of Western vaults. These are not separate stories running in parallel. They are one story, and tonight the chapters are converging faster than most traders are prepared for. Start with the divergence, because it is the most telling signal in the entire picture right now. Silver's Western spot price closed Friday at $84. Shanghai is pricing the same physical metal at $96, $12. That gap between what the paper futures market says silver is worth and what buyers in the East are actually paying for real, deliverable metal is not a rounding error. It is a structural fracture. When premium spreads of that magnitude persist, the market is telling you something the headline price cannot. Physical demand is outrunning the paper claims stacked on top of it. Meanwhile, COMEX total silver inventory registered 349 million ounces as of Thursday, down 2.2 million ounces in a single session. 9 consecutive weeks of net declines. The weekly drain rate hit 8.4 million ounces, nearly 262 metric tons removed in 1 week. London's LBMA warehouse simultaneously reported a 2.4% drop in February, now sitting at 870 million ounces. Both major Western depositories losing metal at the same time, in the same direction, against the same backdrop. You can manipulate a price. Algorithms do it daily, but you cannot forge a warehouse receipt. When the physical inventory reports confirm what the premium spread is signaling, that is not sentiment, that is mechanics. The paper veil only holds as long as the metal behind it does, and tonight the metal behind it is moving east while oil is on fire. To understand why this moment has been building, why the architecture of this convergence was inevitable, we need to step back from the weekend as headlines and look at what the systems underlying them were designed to do. Because this didn't start Saturday. The blueprint was drawn years ago and most people have never seen it. The Strait of Hormuz is 21 miles wide at its narrowest point. Through that channel flows approximately 20% of all the oil traded on Earth. Every supertanker carrying Gulf crude to Asia, every liquefied natural gas shipment bound for European terminals, the vast majority pass through water that Iran can see from its coastline. The geographic reality has always made the strait the pressure valve of global energy markets. What changed this weekend is that the valve is no longer theoretical leverage. It is active terrain in an expanding conflict. The sequence of events matters more than any individual headline. U.S. and Israeli forces struck major oil infrastructure inside Iran. Iran responded by hitting a desalination plant in Bahrain, a choice that is strategic, not incidental. Kuwait draws 90% of its fresh water from desalination. Qatar approaches 100%. The UAE and Saudi Arabia both exceed 70%. When a military actor deliberately targets water infrastructure along a coastline where major oil producers are functionally dependent on that infrastructure for civilian survival, the conflict has crossed from military exchange into something more systemic, infrastructure warfare. Energy systems, shipping lanes, and water supply are now simultaneous targets across the same geography. Saudi Aramco surged by its largest single-session gain since April 2023 on Sunday. Underneath that move is a company already rerouting. Ras Tanura, Saudi Arabia's largest refinery, halted operations after last week's strike. Aramco is now moving shipments through Red Sea facilities on the kingdom's west coast, bypassing the strait entirely, with 8 supertankers already loaded this month on pace for a record. They also raised April oil prices for Asian buyers by the most since August 2022. These are not defensive postures. These are the operational adjustments of a company that has made a duration assumption about this conflict and priced accordingly. Now place this against the historical template, because markets have seen supply shocks of this shape before. The last time energy markets carried this particular combination, physical supply disruption, inflation already elevated, and dollar credibility under stress, it was the 1970s. That decade produced commodity returns that seemed impossible to conventional models. Gold moved from $35 to over $800. Silver's trajectory was similarly parabolic from its suppressed base. The inflation that emerged from that supply shock was the kind monetary policy alone could not extinguish, because it was structural, embedded in the cost of producing everything. That precedent is not a prediction. It is a reference point for understanding why the assets gaining attention right now are gaining attention. There's also a strategic architecture worth acknowledging because it reframes the geopolitics as economics. Higher oil prices, priced in dollars, mean every oil importing nation must first acquire dollars to pay for energy. That increases global dollar demand even as dollar credibility faces pressure from deficit spending and monetary uncertainty. It concentrates advantage in energy-producing nations and dollar-issuing institutions simultaneously. This is not accidental. It is the inherited design of a system built after Bretton Woods collapsed, and it is currently operating under maximum stress. If this framework is landing, if you're beginning to see these markets as a connected system rather than separate asset classes, subscribe and hit like. What we're about to get into is the layer most coverage isn't touching yet. Here is where the mainstream narrative and the actual data diverge most sharply. Over the weekend, major financial media ran a consistent thread. De-escalation is possible, ceasefire signals are emerging, markets are overreacting, energy markets are not buying it. Hyperliquid's Crude, the platform that prices around the clock without CME's institutional infrastructure, reached a high of $126 a barrel on Saturday before settling near $115. Brent moved 6% on the same platform. These are not algorithmic anomalies. They are the market processing information that hasn't fully reached the paper futures complex yet, because the paper complex was closed. Now add the geopolitical layer that the energy price is actually pricing. Reports indicate the United States and Israel are planning to deploy special forces into Iranian territory with the objective of seizing Iran's nuclear stockpile, approximately 450 kilograms of highly enriched uranium enough material for roughly 10 nuclear weapons. If that operation moves from planning to execution, this conflict is no longer an air campaign with defined parameters. It is a ground incursion into a sovereign nation with declared nuclear capability. The duration calculus for every market, oil, metals, equities, currency, changes entirely when that threshold is crossed. Iran has already selected a new supreme leader and will announce the appointment shortly. Israel publicly stated it will target every leader Iran appoints. Iran declared it is prepared for full-scale war. President Trump, when pressed for a timeline, said, "Whatever it takes." 3 words. Not a de-escalation framework, a war economy posture. The U.S. has spent approximately $6 billion in the first week of active engagement alone, $4 billion of that on munitions, primarily missile interceptors. A spending rate of that magnitude is not a sprint. It is an infrastructure commitment. It implies a duration assumption that policymakers have not stated explicitly, but markets are beginning to price implicitly. China stepped into this frame at the National People's Congress this week, with Foreign Minister Wang Yi formally stating that China stands ready to restore order, tranquility, and peace to the Middle East. Read that carefully. This is not a humanitarian gesture. Iran is a central node in China's Belt and Road infrastructure. Middle Eastern oil flows primarily to Asian markets. Beijing is positioning itself as a stakeholder in the region's post-conflict architecture at the precise moment the existing architecture is under maximum pressure. That positioning has strategic value that extends well beyond this conflict's immediate geography. Meanwhile, the risk asset picture confirms the same red. Over $190 billion exited the crypto market across 3 sessions. Bitcoin shed more than 8%, Ethereum approached 10%. The S&P, NASDAQ, Dow, and DAX all closed lower Friday. $900 billion wiped from U.S. equities in a single session. When risk assets across every major class move in the same direction simultaneously, they are not reacting to noise. They are repricing a fundamental variable, the duration and scope of geopolitical risk. And if you think that is the complete picture, we have not yet touched the part that is happening inside the financial system itself, the part that has nothing to do with missiles and everything to do with where capital is trapped right now. 3 of the largest alternative asset managers in the world hit the same wall in the same window. That is not coincidence. That is a cycle. BlackRock limited withdrawals from its $26 billion HPS corporate lending fund after receiving $1.2 billion in redemption requests in a single quarter. They capped payouts at 5% and blocked the rest. Blackstone's $82 billion fund faced record withdrawal requests the same week and had to inject $400 million of its own capital to cover exits. At Blue Owl, investors pulled 15.4% out of one fund in January, forcing the firm to sell $1.4 billion in loans to fund redemptions, and then permanently halted traditional withdrawals at that vehicle. 3 firms, same window, all hitting the wall. Howard Marks wrote that cycles turn at the point of maximum complacency, when risk feels most distant. 18 months ago, private credit illiquidity was not a concern anyone was pricing. It was the consensus trade. Institutional capital flooded into private lending vehicles precisely because they offered yield without the volatility of public markets. What that trade obscured was a structural feature, not a bug. These instruments are designed with limited redemption windows. When the macro environment shifts and investors want liquidity simultaneously, the mechanism reveals itself. The doors close, not because the assets are worthless, but because the architecture was never built to handle synchronized exits. This matters for the metals picture in a specific way. Capital looking for an exit from illiquid structures needs somewhere to go, and the signal in gold right now is deeply unusual. GLD, the largest gold ETF in the world, recorded one of its largest weekly outflows in recent memory, $4.2 billion left in a single week, at prices near all-time highs. Someone is selling paper gold aggressively, and the spot price is not moving. Gold held above $5,170 through that volume of selling. When sellers of that magnitude cannot push a price down, the bid structure underneath is not weak. It is anchored. Physical buyers are absorbing every paper sale without flinching. That divergence between paper behavior and physical price structure is the signal worth sitting with before tonight's open. Here's the question. Nobody in mainstream coverage is asking directly. If 3 of the largest private credit funds are simultaneously blocking exits, if paper gold is being sold at record volume without moving price, and if oil infrastructure is burning across the same geography that holds 20% of global supply, what does that tell us about where we actually are in the cycle? Is this a geopolitical shock that resolves in weeks? Or is it the visible surface of a structural repricing that has been building in private credit markets, physical commodity markets, and sovereign balance sheet dynamics simultaneously? Drop your read in the comments. The most incisive analysis on this channel consistently comes from people who are connecting dots across asset classes, not just watching one market. What I'm about to close with isn't about institutions and abstractions. It's about what this framework means for purchasing power, savings, and the assumptions most people are still operating on, assumptions that may no longer be current. Silver draining from Western vaults for 9 consecutive weeks, while Shanghai prices at $12 higher than London. Gold absorbing $4 billion in paper, selling without moving. 3 major private credit funds blocking exits in the same quarter. Oil infrastructure struck in the world's most critical energy transit corridor, a conflict with stated objectives, nuclear seizure, regime targeting, that imply duration, not resolution. China formally positioning as an arbiter of the post-conflict regional order, and a U.S. spending rate of $6 billion in week 1 that functions as a duration signal regardless of what press briefings say. These are not isolated events. They are simultaneous pressure points on a system built around assumptions that are now actively being tested. That dollar-priced paper claims on commodities are equivalent to the commodities themselves. That private credit liquidity is available when it is needed. That geopolitical risk in the Gulf is a spike, not a structural condition. That inflation, once tamed, stays tamed. The 1970s parallel deserves one final beat, because it is instructive, not just for the commodity returns it produced, but for what it revealed about the limits of policy response. When supply shocks become embedded, when the cost of energy is not a transient disruption, but a persistent new floor. Interest rate adjustments cannot reach it. The Fed cannot drill a well. It cannot reopen a refinery. What it can do is manage the financial symptoms of a structural shift, often at significant cost to the broader economy. What protected purchasing power in that decade was not bonds, not equities, and not cash. The assets that held value were the ones with supply constraints that no central bank could override. That is not investment advice. It is historical observation. And the distance between those two things is exactly where your own judgment lives. Here is what remains genuinely uncertain, and intellectual honesty requires saying it directly. Hyperliquid, whose weekend prices are directional signals from a platform without CME's institutional depth. A ceasefire announcement, a dollar spike, or coordinated algorithmic pressure at the open could flush speculative positions fast. CPI prints Wednesday, GDP, PCE, and JOLTS all hit Friday. Any one of those data points landing in an unexpected direction gives paper sellers a window that has nothing to do with the physical market's underlying structure. Short-term volatility does not care about your thesis. Respect that. We opened with a question that the metals market has not yet answered. PAX-G and Kinesis Silver are flat from Friday's close, while oil trades at 115, and Tehran's skyline is obscured by smoke. What does the metals market know that we don't, or what is it about to learn? Here is one possibility. Sometimes the market that appears to be lagging is actually the one reading the situation most clearly, absorbing the information quietly before the rush. And sometimes the question itself is the signal. Verify everything referenced here. COMEX inventory reports are updated daily and publicly available. LBMA statistics are published monthly. The BlackRock filing is on Reuters, dated March 6th. Primary sources don't require trust. They require 15 minutes. The war economy doesn't announce itself with a press release. It announces itself in warehouse receipts, withdrawal caps, and the price of a barrel at 2 in the morning when the major exchanges are dark. You've now seen the receipts.